This morning we're going to continue to look at investment trusts. If you remember from our session last week, before the new year, investment trusts are an investment which can be purchased through stockbrokers or through asset management companies. And investment trusts are becoming popular again and should probably form part of somebody's portfolio. If you do not have access to investment trusts, then you need to speak to someone who can give you that access, or go direct to the asset management companies. I dealt with the history of investment trusts last time, gearing, which is of course investment trusts which borrow, and dealing in investment trusts themselves. This week we're going to look at things like the net asset value, discounting, and the different types of shares in issue, and the split capital investment trust. First of all, I need to just reel off the learning outcomes. Again, this is a requirement that we have to do for the SPS. By the end of the session, you will be able to discuss the relevance of the net asset value per share and its influence on the purchase of investment trusts, particularly with institutional investors. Describe the premium, the discount to net asset value, including the impact and the consequences of that. Understand a split capital investment trust, which is a more risky type of investment trust, which has a specific wind-up date. Explain the priority order on the winding up of a split capital investment trust with regard to the shares that are in issue. Now, if there is a pause, it's because I'm waiting for the slides. I don't think I've dropped off or gone to sleep or anything like that. Sometimes the slides which I click forward take a little bit of time on moving forward wherever you are. So again, I will sometimes wait while the slides move forward. The net asset value, the NAV, of an investment trust is the net worth of the trust expressed in terms of the value of a company's assets per share. I'll say that again. The net asset value of an investment trust is the net worth of the trust expressed in the terms of the value of a company's assets per share. If you remember from the previous session, an investment trust takes your money, my money, investors' money, and it purchases underlying assets, and those underlying assets tend to be shares of other companies. And so the value of an investment trust is the value of those underlying assets less certain costs and liabilities. The calculation of the net asset value and the resultant figure is one of the most vital pieces of information when determining the true value of an investment trust, especially important if it is a split capital investment trust. It is essentially the net worth of an investment trust equity capital, usually expressed in pence per share. The calculation, the way you arrive at that figure, is to add together the value of the trust listed investments at their mid-market prices, the value of its unlisted investment at the director's valuation, and cash and other net current assets. So there are three different types of valuation: those that are listed, those that are unlisted, so you could have AIM listed shares which are classed as unlisted, and then you've got cash. All added together. Once you arrive at that figure, you deduct from that, from the total is deducted the company's liabilities, including any issued preference capital. They're known as preference shares at their nominal value. The resulting figure is the asset value, or sometimes referred to as the shareholders' funds of the trust. It is the shareholders who hold the beneficial interest of an investment trust. So whatever its value is, that value is the shareholders. All that is left to do once you have that figure is to divide the shareholders' funds by the number of shares in issue. This gives the net asset value per share. The valuation can be carried out on a frequent basis. It can be done on a monthly, weekly or daily basis. So one of the first things that you need to do if you're into investment trusts and you're thinking of buying investment trusts, and you can get this information available on most of the good sites that deal in this, the FT, FE Trustnet and so on, is to look for that net asset value figure. So that can sound like gobbledygook and can sound very difficult. So let me give you an example, a very simple example of how that might work in practice. This is an example of what we call the undiluted net asset value figure. The net asset value of an investment trust with assets of 18 million, liabilities of 6 million and 24 million ordinary shares in issue, based on the formula we've just discussed, would result in a net asset value per share of 50 pence. In other words, that's 18 minus the 6, giving us the 12 million, divided by the number of ordinary shares in issue, tells me that my share should be worth, every share that I own would get me 50% of the value, 50 pence of the value of the trust. So if I hold 10,000 shares, they're worth £5,000. This figure, however, as I've said, is what is called an undiluted figure, in that it does not make any allowances for warrants in issue. In order to allow for warrant holders taking up their subscription, the subscription price is added as an asset and the new shares deemed to have been created. I haven't got time today to go into warrants. I'll maybe cover that off at another time. The formula for calculation for the diluted net asset value you can see on the screen. Again, please, for those who are new to this, the slides will obviously help. You don't have to take everything in all in one go. But obviously if you want the diluted, you have the net assets, which is assets less liabilities, plus the warrant subscriptions divided by the shares in issue, plus the new shares which would become available should the warrant holders take up their options. As we saw before the new year, the price of investment trust shares are governed by the market forces of supply and demand, because investment trusts are closed companies. They issue a finite number of shares linked to share issues and of course warrants. Most investment trust shares are traded on the London Stock Exchange and therefore priced at a discount or a premium to net asset value depending on demand. It's very unusual for any share to be trading at their par value, their face value. When the price of shares are on the up, investment trust shares are stronger, and it is at such times that there are plenty of new investment trust share issues around. So when it looks as though investment trusts become popular, companies will issue new investment trusts and attract more investment in. That's what we're saying there. Of course, when markets are rising over a period of time, you'll find many investment trusts trading at a premium over their net asset value. However, for many years, many investment trust shares have been trading at a substantial discount. This recent common occurrence ought to act as a red light to any investor looking to invest in a new issue of investment trust shares, as they may see an immediate fall in value. And one of the ways that investment trusts compensate for the fall in share value from the initial issue is through the issue of warrants, and those warrants make then it attractive for new investors to take up the share issue. So for people like me, probably getting it in at a new issue is probably not the right thing to do. We will probably be better to wait until the shares have settled down and then buy into the investment trust. Although the purchase of new share issues, which are largely at a premium for us normal investors, that should be carefully considered and probably avoided by those not experienced in dealing with this particular type of investment market. The purchase, however, of these types of shares might be worthwhile given the substantial discounts that are floating around. So if you want to have a look around, you can get websites that clearly just deal with investment trusts and see what they're trading at. You might find yourself getting interested. In general terms, the lower the discount, the better the management record. So as a large discount does not necessarily mean that the share price represents value for money, or that it is a good buy with success written all over it. So there might be reasons as to why it's trading at a discount, and those should be looked into. Let's have a look at how to calculate premium or discount. So we know what the net asset value is of a share. We can work out that. What we're saying there is if an investment trust was to wind up and realise all its assets, the net asset value is what I should get for that wind up. Those payments should come to me as a shareholder. Now what we're looking at is, I know the net asset value, I know that figure. Now I can work out, are they trading at a premium or are they trading at a discount to the net asset value? And I can use this as a way of saying, do I now purchase these particular types of shares? So the premium or discount can be calculated using the following formula. And you might want to make a note of this, because I've got an example for you to do on the next slide, I think. So the calculation premium or discount is calculated as the share price minus the net asset value divided by the net asset value times 100. So there's an example on the screen. We have trading at £1.80 per share, and the net asset value per share after we've done our calculation is £2. So we do the £1.80 minus the £2 divided by the £2 gives us a discount figure, and you've got to obviously multiply it by 100 for a percentage, gives us a discounted figure of minus 10%. A negative always implies that the share is trading at a discount. So what we now have to work out with that share is there some reason for that discount, and would it be worth getting in? Because as the money pours into this investment trust, as these shares are traded, the price is inevitably going to rise. And so I would like to know in this particular example what it is the investment trust is holding as far as underlying assets are concerned, and then look at the reason for why it's trading at a discount. Now unfortunately for us, if you get an investment trust trading this low, there's maybe something wrong, because institutional investors will have already piled in and started to push the price up. So now it's your turn. So on the following slide, you've got some investment trust share prices, net asset value per share, and what I want you to do is to tell me if they're trading at a discount or a premium, and if you can come up with the figures, that would be even better. please put your answers in the chat box, please, and I will tell you how you're getting on. So I will go silent for a little while you're doing this. So here's the investment trusts on your left as we look at it, the price per share, the net asset value. Please work out and tell me whether they're trading at a discount or premium, and if you can, what the figures actually are. No rush, you've probably got about 4 or 5 minutes to do this. So again, well done, Daniel. Yeah, someone's got the first one spot on. You tend to round them up, Dan. But yeah, spot on with the answer. I'm not going to read the answer out. I'm not going to fall for that trick. Okay, but well done, Daniel, on the first one there, Dale Gifford. Paul, if you can do the figures, that'd be great. If you don't want to do the figures, just tell me whether they're trading at a discount or whether they're trading at a premium. Well done, Clive. First one done. Well done, Paul. Fiona, well done, yes. Wow, we've got coming through thick and fast now. Most of you have got the first one, so I'll give you the first one, yeah. Dale Gifford. I can't put it up yet because it comes up in the more, but Dale Gifford is, I've rounded it to 5%. Most of you have got 4.99 or around that price. So yes, and of course it's trading at a premium, because that is a plus figure. Yeah, I think you've got the general idea. Pacific Horizon, got a slightly different figure to that, so we'll see. Could be me that's wrong, I'm not infallible. Let me put up the answers. You've got the general idea, I think, of how to work this out. So there we go, there are the answers. I just rounded them. And these figures were actually taken, these were real figures some time ago now, but these were real figures on these particular investment trusts some time ago. And these were what the discounts and premiums actually were on these investment trusts. So well done for calculating that, and thank you for your efforts in getting those answers. Again, when you read the information sheets and when you look at investment trusts, of course you will not have to work these figures out. They should be given to you. Okay, well, let's move on. There are a number of reasons why an investment trust may be trading at a discount. So now we know that something can trade at a discount, and we know it's down to supply and demand, and we know that when investment trusts are initially traded, they tend to immediately go down below their net asset value and trade at a discount because of the warrants that are attached to them. So there are a number of reasons, but let's have a look at why we can be trading at a discount. If the investment trust were to be wound up, the feeling is that the trust assets may not realise their full value due to dealing costs. So of course, if there's red lights being flagged up the nearer we get into those wind-up dates on split capital investment trusts, we're going to see people trying to offload those shares, and therefore they're going to start trading at a discount. Secondly, management and administration expenses incurred by the investment trust structure reduces the value of the dividend payments. That's the flow from its investments. So again, if they have high costs, someone's got to pay for those costs, and those costs are obviously going to come out of profits, thereby affecting dividend payments, especially as we'll see for income shareholders. There is another reason for trading at a discount: relatively low demand, because the investment trust may be too small to attract institutional investors, and it's the institutional investors, your big pension funds, your with-profit funds to some degree, which hold masses of these sorts of things, that drive the price. So if an investment trust is too small, is not on the radar, and there's no one specifically interested, of course that will mean that it's trading at a discount. Of course, it could purely be adverse sentiment in relation to the sector or a country or a commodity in which the investment trust focuses. And therefore, if I'm investing in, I don't know, shares in Europe at the moment as an investment trust, I might be having a bit of a rough ride, and of course there might not be much need for me to invest in that investment trust. Conversely, an investment trust operating in an attractive sector where there are few competing trusts will find that high demand relative to supply will make its shares trade at a premium. The following apply to investment trusts trading at a discount. Let us say an investor buys shares in investment trust that are trading at a discount. The net asset value per share is £2 and the market price is £1.80. There are two consequences that follow from this. Increased income. The investor will need to pay commission and stamp duty on the acquisition of his investment trust shares that will probably amount to roughly 1.5%. However, the income is based on the net asset value price, not on the market price, making the investment worthwhile from an income perspective. And again, we could go into yield, dividend yield here. If I'm trading at a discount and I buy shares at a low price, and the dividends are actually based on a higher price, i.e. the net asset value, that can make it attractive if I'm interested in income, i.e. dividend yield. Secondly, amplified capital gains and losses. Discounts on investment trusts tend to narrow in a rising market, obviously, and get wider in a falling one, amplifying the effect of the change in the net asset value. Thus it has a similar effect to that of gearing, making the investment more risky. A split capital investment trust is like any other investment trust in that it has a single portfolio of investments. However, a split capital investment trust issues a number of different classes of shares, with holders of each class having different entitlements to returns of capital or income the trust produces. A split capital investment trust also has a limited life and is created with a predetermined wind-up date in mind. In fact, amongst other things, the lifespan of the trust and the period which remains to its wind-up has a significant impact on how the prices of the different classes of shares move within the trust. Split capital investment trusts allow the professional fund managers to provide different returns to investors who have differing levels of risk and strategy needs. For example, if a low risk but rising income is required, stepped preference shares might be suitable. If an increasing income is required but high risk is acceptable, an income share might be more appropriate to that type of investor. The capital value of all classes of share will vary right up until the trust has wound up. At that stage, the amount of capital returned will depend on the class of share and the order of priority in which the trust is wound up. That is, has it got sufficient assets to meet its obligations, hence the risk to different types of shareholder classes. As we have seen, a split capital investment trust can issue a number of different classes of shares as set out in the table. So a split capital investment trust issues, I've just put a number of the more common types of share that you'll find a split capital investment trust issuing. So you've got an income ordinary share, so we would expect to see income rising, maybe high yields on that at a predetermined value of capital returned at the end. So what they're giving up is the potential of growth in the share price for income. The second one, income and residual capital. Again, we have a high income, possibly rising, and we are given access to the surplus capital, if there is any, of course. You've then got the person who is carrying all or most of the risk, that is the capital shareholder. So if this person's investing in capital shares, then they have no access to income. They will get the remaining surplus. Most capital ordinary shares, not always, but most times, they will be last in the order of priority. So they're carrying most of the risk at wind up. We then have preference shares, which give a high safety margin. The amounts of income that they will receive is predetermined, as is the capital that will be returned at the wind up of the trust. And then finally you have zero dividend preference shares, which again don't pay out an income, but they have a predetermined capital return at redemption. So what I'm going to do is I'm now going to look at those different shares in a little bit more detail. As there are different types of share, there are different types of income producing share. A financial advisor must be very clear about the terms which apply to the different types of share, including income shares. Some can result in a substantial loss of capital. In general, income shares pay regular dividends from surplus profit on the trust assets. They also have a predetermined maturity value known as the redemption price, which is typically the same as the par value, that is the nominal value or issue price of £1, although it could be less. So I've invested £10,000, I'm going to get £10,000 back at redemption. The redemption price is paid subject to there being sufficient assets remaining after debts and other preferred classes of share having been paid out. The market price of income shares fluctuates above and below their redemption price, depending on the prospects of dividends being paid and the time left to redemption. Some income shares pay high income, but only have a nominal redemption value, for example 1p, whilst others may offer a return of the initial investment capital, but a lower income return. Shares which offer a nominal redemption value may be attractive to an investor who has capital gains on other investments that can be offset against this particular loss in this investment. So obviously I've invested so much, I know I'm going to get back less than what I invested, therefore that loss can reduce capital gains on other investments. So that's the income share, the ordinary income share. The income and residual capital shares, sometimes known as ordinary income shares, just to confuse you, or highly geared ordinary income shares, offer the potential of a high and rising income plus all the surplus assets of the trust at the date the trust is wound up, after other priority ranking class of shares have been repaid. They have no predetermined redemption value and are the last, generally because they are a capital share, in order of priority of shares to be satisfied. If the split capital investment trust issues a combination of income and residual capital shares and zero dividend preference shares, holders of the ordinary income shares are entitled to all the income generated by the trust, while the residual capital shareholders have to wait and see whether or not their share has been worth holding on to. If, on the other hand, they are issued in conjunction with stepped preference shares, the holders of the ordinary income shares will receive all excess income after the predetermined level of income has been paid to the preference shareholders, hence why they're called preference shares. They get their cut first. Income and residual capital shares offer the potential for high dividends and capital returns, although their high gearing and no guarantee does make them a relatively high risk investment. The one outstanding thing about capital ordinary shares is that the holders of such shares are not entitled to any dividend payments. Instead, the holders receive all of the capital remaining after all other share issues have been satisfied at redemption. The total absence of any guarantees means that those holding capital shares are holding investments which are inherently risky. Capital shareholders are the last in line in order of priority to be satisfied when the investment trust matures. If there is nothing left, they will walk away empty-handed. That is, they will lose their investment. However, where there is high risk, there is potential for great reward, and so investors put their money into this investment looking for substantial returns at maturity, whereas of course they may face significant losses through, for example, extravagant or high gearing which is undertaken by the professional fund manager. Let's have a look at this in example. Now, of course, like everything, you will have a look at your clients and you will have to assess their risk profile. So I can imagine some of you sitting there saying, my goodness, or words to that effect, I've never invested in these sorts of things. But it depends, doesn't it? It depends on a person's wealth. It depends on their attitude to risk, their risk profile, and it depends how much money they can afford to lose. And for some people, they find this type of risk very attractive, whilst others prefer to be more cautious. So here is an example. Pickwick Papers Investment Trust has 500,000 income shares which have a predetermined redemption price of £1, and they've also got 500,000 capital shares. The investment trust has an asset value of 500,000 with 10 years to run to redemption. If the fund grows at an average of 10% compound for 10 years, the fund will be worth 1,296,871. I don't know why I couldn't have just rounded that to 1.3. I must have been in my obsessive pedantic mode at that time, but there we go. 1,296,871 at redemption. The income shareholders will be repaid at £1 each, because that's what's been agreed, and they've had the income generated by the fund. This allows, sorry, they will get their £500,000. This leaves £796,000 for capital share investors. That is £1.59 per share. Therefore, they've made some money on their investment. If the growth rate was 11%, the fund would be 1419, near enough 15. This will give the capital shareholders 1.84 per share. Now, what we can see in this, the small increases in growth give larger increases in capital returns. So that the more money there is in the investment trust, smaller growth gives good returns for capital shareholders. And that's all I'm really trying to show there and demonstrate there of the value. However, what we do have to say, if the fund was worth 500,000 at maturity, the capital shareholders would not be paid, as the income shareholders would receive their payment first. So they will be first off. Therefore, the capital shareholders would be left with nothing. So if there is no growth in assets, or the gearing has gone particularly badly and liabilities have increased and things have gone badly wrong, capital shareholders will not receive a penny. If there is no money in the investment trust at all, which is what happened with some split capital investment trusts when the tech bubble burst, then no one gets anything. No one gets anything at all. Just a mention of stepped preference shares and zero dividend preference shares. A stepped preference share is a type of preference share with a twist. They pay a fixed dividend which increases in value over time, assuming of course the profits are made. The stepped value occurs during the life of the trust. It has a predetermined redemption value when the trust is wound up at redemption. The guarantees that this type of preference share offers makes it an ideal investment choice for those with a lower appetite for risk when it comes to equity investment. An example of a stepped preference share would be, in the first year, the share might pay a dividend at 5%. In the second year, it would increase to 5.1. In the third year, 5.2, and so on. Finally, we have zero dividend preference shares. Zero dividend preference shares, or zeros as they're known, generate no dividend income, but do offer the holder a fixed capital return at redemption or maturity of the investment trust. The fact that they pay no income means they are of particular interest for tax planning, especially if the annual capital gains tax allowance is used to shelter profits. For example, an investor may hold a number of zeros, all with differing maturity dates. As one matures each year, the annual allowance can be used to cover the first part of any realised gain. For example, a person might hold a number of zeros which were issued at £1 and are going to be redeemed at £2. Therefore, if an investor invested £11,000 today, knowing that they would double their return at maturity, there would be no capital gains tax to pay, because the gain is covered by the annual allowance. This makes them attractive, therefore, for those requiring regular capital withdrawals at certain points in time. They are considered to be on the low end of the risk scale because of the guarantee that's given to them as far as equity investments are concerned, as they pay out a set amount at a set time and are ranked first in order of priority when the investment trust winds up. However, zeros should not be considered in the same risk category as cash-related investments. They are equities. Until 2002, zeros had always paid out when required. This certainly was achieved through a reduction in risk because of the support structure of other types of splits being in place. However, their popularity meant that some split capital investment trusts cut corners and were set up without the supporting structure of other share class issues. In 2002, some zeros therefore did not pay out, meaning people lost money. However, we did see a return to sound split capital investment trust structures being reintroduced because of the difficulties that were experienced. I quite like them. It's quite a thing to get involved in them, but again you have to have the money and the appetite for this type of investment and know a little bit about what you're doing or be involved with someone who does. At the predetermined date, shareholders will be asked to agree to wind up the investment trust according to procedures laid down in the Articles of Association. In certain circumstances, and as long as it's contained within the Articles of Association, the shareholders may be given further options to continue the life of the investment trust or of rolling their investment over into newly constituted investment trusts. Doesn't happen a lot, but it can do. If the trust is wound up, the different classes of shares are repaid, obviously once all liabilities have been settled, in order of priority after repayment of loans or debentures. If there are warrants, these are ranked last and paid after all other classes of share have been fully satisfied. The repayment of each share class follows a particular order, both in respect of dividends paid from the income earned by the trust during its life and in respect of capital paid from the assets of the trust at the winding up date. The highest priority at wind up is given to zeros, then we come down to other preference shares, ending up at the lowest priority given to capital shares. Although a split capital trust has a limited life, shares can be traded. They're called negotiable investments, so they can be traded and sold at the prevailing market rates at any time during the life of the investment trust. Of course, like any equity, the market price fluctuates and is largely based on market sentiment, time to redemption, and of course supply and demand. I'm going to continue next week looking at investment trusts, and we'll look at analysing performance, other share classes found with investment trust taxation, and possibly regulatory issues as well. But I thought we'd finish by looking at the investment powers afforded to the investment trust. Though investment trusts have existed since 1868, they are currently regulated by the Company Act 2006, under which they are classified as investment companies and subject to special rules relating to the distribution of the profits that they generate. Investment trust companies are those that satisfy additional criteria from the Income and Corporation Taxes Act and the UK LA listing rules. As with other companies, an investment trust is bound by the rules set out in its Memorandum and Articles of Association, which are set up when the company is formed. The investment powers of investment trust companies may be limited by the Articles of Association and of course the counterparty, which is the London Stock Exchange. However, the limitation is about what the trust is mandated to invest in, not a restriction on the type of assets in general that it can hold. That is, it can hold investments, other asset classes, rather than just stocks and shares. Under stock exchange rules, there are a number of constraints on the level of investments that can be held and undertaken. For example, 70% of the income of the investment trust must be derived from investments in shares and other securities. No individual investment may total more than 15% of the overall assets held by the investment trust. The regulators are obviously concerned about concentration risk. That is, they do not want investment trusts to put all their investment eggs in one basket and thereby expose investors to the specific risks posed by holding just one type of investment. You are now able to discuss the relevance of the net asset value per share, describe the premium discount to net asset value including impact and consequences, understand split capital investment trust and the different classes of shares, and explain the priority order on the winding up of a split capital investment trust. If you just hang on there, guys, I've got a question here. I think the stock increase in value to above 15%. Yes, it will, Gregor. What Greg has asked me there is if the stock held by an investment trust goes above the prescribed regulatory amount of 15%, will the fund managers have to make readjustments? Yes, they will, and they have a time period in which to do it. Okay, so they will have to make that almost like a balancing of the assets held within the trust. Now, this has been an SPS session. I do run other sessions which are tailored to different types of people. We've got will writers, we've got those who are interested in trusts, taxation. So I run different sessions for different groupings. I run master classes as well, tailored to individual needs. By all means, you are able to attend some of those sessions. Some of the sessions you have to be involved with the company in various ways, but please, if you are invited to a session, please join me. It won't always be on investment trusts. It will cover off maybe trust law, wills, inheritance tax, estate planning, and so on. But I hope you've enjoyed this session today. Please have a look at investment trusts. See if there's something that maybe your investors should be considering. They used to be very popular. They can be invested in on a monthly basis.